By the way, we just want to talk about PSU bank stocks for a second because all of them are up today, including Canara Bank. The PSU banking index itself is up about 0.8%, so almost 1% higher. Folks, you'll remember yesterday there was a lot of concern in the market, right, about this ECL provisioning, expected credit loss. Well, Abhishek and, Lata and I were doing a discussion on this and taking some feedback as well. And it seems that, yes, for PSU banks, the provisioning requirements probably will be higher because now you provide from day one and you don't wait till there's a default and then look at, added buffers over there. I think the read-through seems to be that there's a 5-year staggered period to move into this transition. And overall, it's actually good for the health of the banking system, especially at a time when a lot of banks have been pushing very hard on the retail book. Yeah. So perhaps, if investors are willing to take a longer-term view, then not so bad. But short-term, we'll have to see individual banks, how they do.
The thing is, CLSA had come out with a note and they had said that we were expecting ECL provisions, I think 0.8 to 1.5%, thereabout. So on an average, assume 1%. And then you had Canara Bank, which said it's going to be 5%, right? I know they took it all up front. It's just that the number 5% was so much more than what the analyst community was anticipating. As I said, it was close to about 1% according to CLSA's estimates for PSU banks. That took the street by surprise, and we saw that sharp correction in the way forward. But as we've been pointing out, this is only a proposed regime. But we'll take the way forward with Anil Gupta, Senior Vice President, Co-Group Head of Financial Sector Ratings at ICRA, to discuss this in greater details. Anil, morning, and thanks so much for joining in. Rima here. How do you see this play out? Right now, it's only a proposal. Banks have been given a 5-year window to implement this. Take us through your key takeaways.
Yeah, hi, good morning. So we have published a note on this transitioning to the ECL framework when the discussion paper was floated. And broadly, what we think is that the draft guidelines should come somewhere in financial year 24. And maybe the opening balance sheets for, let's say, April 1st, 2025 should basically reflect some sort of an impact on the net worth and the provisioning which the banks, let's say, take on the transitioning front. Now, coming to the specifics, like what we are looking at, let's say under the ECL framework, you have to take a upfront provisioning, unlike a standard asset provisioning of just 0.4%. The main concern comes from the loans which are in a DPD buckets and not NPA. So NPAs is not an issue given the banks are largely provided to the extent of more than 85-90% on their recognized stress book. But wherever we are having loans which are in, let's say, overdue buckets, 30 DPD, 60 DPD. So currently, if you look at the NBFCs says that stage 2 loans are which are 30 DPD. But the discussion paper which has been floated by RBI says that banks possibly will be given some sort of a relaxed maybe treatment where stage 2 will be, let's say, 60 plus DPD loans. So we have to see the final nitty-gritties, what sort of a classification of these loans happen whenever the discussion paper or the final guidelines come. But we do expect that there will be an impact. Basis our discussion with some of the banks. So what we do is we don't look it as a percentage of the loan book, the provisioning. We look it as a percentage of the, let's say, the existing capital. So let's say if a bank is reporting 10% of the as a core equity capital, what will be the core equity capital after you have taken those provisions? Let's say you have to transition to ECL. So ECL will be one part of the provisioning which will be required towards migration of Ind AS. And what we discussed with few banks is that the impact could be as high as up to maybe 300 to 400 basis point. So a bank which is reporting, let's say, 10% CET on a Ind AS transition basis, it could be maybe close to maybe 6 to 7% on an adjusted core capital.
That's
yeah, please.
Anil, sorry. Just to react to that, that seems fairly high because, again, I think everybody is grappling with putting numbers to this. I think there was a Morgan Stanley estimate. They said 5% to 20% of net worth. You're saying the impact could be 300 to 400 basis points of capital. So which are the banks? I know you can't get into specific, stock names, but any references will help. Within PSUs, which are the banks which perhaps will feel the pressure, which perhaps will have to go in and raise capital? Will this be more apparent? Because the legacy book, the corporate lending book, legacy book, all that AQR, all that cleaning up has already happened. So will this be more felt where, let's say, the unsecured portfolios are pretty huge? Some more color.
Yeah, sure. So what we have said in our note also is that two things: banks where we are looking at the restructured book is high or the overdue DPD book is high. So that is one category of banks where possibly the transitioning, because these are the stressed loans and maybe carrying a provision, let's say 0.4% if they are in DPD buckets, or let's say 10% minimum provision which the RBI has stipulated on the restructured loans. Whereas on a ECL basis, this number could be much higher. Second, if we look at the recent cycle on the NPAs, so when you do the PD and the LGD, you look back into the last few years. So it can be a 5-year time frame, 7-year time frame, 10-year time frame. And if we go by the recent precedents of corporate cycle in terms of NPA, we had a very high LGDs, right? So that will drive a much higher ECL, even though today the asset quality is looking much better. Similarly, on the retail side also, yes, you mentioned it correctly, the unsecured loans will throw up a high LGD number. But if we again look at the last couple of years, COVID has basically distorted that assumption on the PD and LGD. So if you have to go by maybe look back period of last 3 to 5 years for ECL provisioning on the retail loans, then COVID will throw up a number which will basically result in a much higher provisions. So we do think that the provisioning because of the recent NPA cycle is going to be heavy. But yes, 5-year time frame is also provided. But at the same time, we do believe that the banks who will take a forbearance in terms of spreading out of the provisioning over a period of 5 years will be considered like maybe a weaker set of banks because typically your adjusted capital ratios is what the investors will look at. So I think the bank should build up the capital buffers before that transitioning date comes. And we are seeing that happening, right? So today the capital ratios of larger PSU banks is much higher. So some banks are at a CRA of 15 to 16% also, which was not seen in the past. So that way, I think maybe over next 1 to 2 years, they can further build onto the capital cushions and take a knock at one go.
Okay, I think that's the indication we've picked up from some of the ones like Canara Bank. Thanks very much, Anil. Very helpful. Thank you for joining in and giving us some perspective on these new provisioning norms. Right now, they're in a draft stage, but at some point in time, we will move to this new format of provisioning and how banks will prep for it. Quick break.